It's Lisa from Been There, Got Out, and I'm excited to have today a financial advisor whose name is Derrick Diksa. We haven't met in person, but we have met virtually, and he's going to give us a whole bunch of tips about dealing with financial abuse, but specifically when you're getting out of a toxic relationship or a divorce and you have to rebuild your life. A lot of times you have to rebuild or build credit in the first place, and tips on what you can do better than maybe what you've heard before because he's the expert and here he is. Yay. Okay, good. I'm relieved. All right. So, Derrick, before we even get into it, one of the things that we talked about when we first met was something I had never thought of, and that is that store credit cards are traps. What?
Yes.
Like, what is that all about? Tell us about that, and then you can introduce yourself.
Yeah, absolutely. So when you're at like a Macy's or Kohl's or any of those kind of stores that have store card offerings, you're usually incentivized with you'll get 15% off today if you sign up for this credit card. And there's no real explanation of what that really means. It is a credit card. So it's going to report to your FICO score and your credit report. But at the same time, if you forget about that card. You get the 15% off and you use the card that day. And what I see often is people forget about those cards and they kind of just go off to the wayside. And you don't realize that you have this card until you get some past due notices. And by that point, it's too late to really correct the the past due payments at that point. It's going to be reported on your FICO score for at least 7 years. So those scorecards I do call traps, but they can be good ways to build credit if you are staying on top of them. And that's the biggest thing that I want to talk about today is how to build credit, protect credit, and really the factors that go into your score.
Yeah, thank you. So, Derrick, now can you officially introduce yourself?
Yeah, absolutely. I'm Derrick Diksa. I'm based here in Delaware as a financial advisor. I'm with Black Diamond Financial Solutions. I've been a financial advisor for about 2 years now. And prior to that, I was working at a large bank helping business owners establish and build their business credit. And once COVID happened, I wanted to make a change in my life. And so I'm working more with individuals now and working more with people in during transitions. And when we talk about transitions like divorce or the loss of a spouse, and my real passion is helping people that may have delegated those financial decisions either during a relationship or after a spouse passed. If they were the ones making the financial decisions, that can be a very challenging time for somebody just to get organized with their stuff, understand what needs to be paid and when, and that's kind of where I see my career evolving.
Yeah, well, your audience here is all people dealing with or having dealt with very difficult separations, divorce, that kind of thing. So money is a huge issue. Often our clients don't have a lot of it. And like you just described, during the relationship, their ex tended to be the moneyed spouse, the one that was earning more money and also knew a lot more about the financial information than they did. So I'm really glad that you're here to help teach us a lot because I know as I was talking to you the first time, I thought, I didn't realize that at all.
Yeah,
And I've been out for more than 10 years, but talk about how credit is not built quickly.
yeah. So credit definitely isn't built overnight, and when I think of a good quote to kind of wrap or tie this all together, I think of Abe Lincoln and where you say the best way to predict your future is to plan for it. And that's essentially what credit is. Credit's going to determine how much you pay for things, whether that's on a credit card, an auto loan, a home loan. It all is going to be based on your credit and what that interest rate is that would be assigned to you. Um,
Yeah.
yeah, so I, I think some things that I wanted to discuss today is what goes into a credit score, the factors that affect that credit score, building your credit and protecting your credit.
Yeah. And before you get into it, I remember like as I was in the throes of my divorce, I had a wonderful divorce attorney, and he said, your number one thing is to protect your credit. Why is that so important, especially as we go through these life changes?
Yeah, because as if you're in a relationship, you have that extra or that second source of income. So that's going to be able to get you higher credit lines if you're applying as a co-applicant or co-signer or co-guarantor, as they say in the credit world. Um, so you have an ability to get credit easier. But like we said, credit can take a lifetime to build, but it can take an instant to destroy.
Mm-hmm.
Something that I see often, especially with divorcee clients, is they're not aware of who's paying the credit cards.
Mm-hmm.
Um, if they are an authorized user versus a guarantor or co-signer, and how that affects the way your credit report is reported. So let's say you're an authorized user. That means that your spouse is the guarantor. They're primarily responsible for that credit card. It's their credit that's going to be affected if they're past due. It's their credit that's going to be affected if they have high utilization or high usage on those cards. Um, but if that card were to go to past due and you're just an authorized user, that's not going to affect you. What is going to affect you is those cards that are in your name and you are the primary guarantor on them, and maybe your spouse was paying the credit card bills, everything was automatic, but then life happens and they stop paying that credit card. Um,
Mm-hmm.
if that credit card is not paid in full, or I'm sorry, not paid in full, if that minimum payment's not made, that's going to show it as a past due on your credit report, and that is going to stay on there for 7 years. And that 7 years is you just don't want to get into that rhythm. So I am going to provide some free resources at the end, and one of them is going to be where you can go to obtain a free credit report for yourself. And I'll tell you what to look for when you look at authorized users versus individual versus guarantor cards.
Okay. Sounds good. I'm listening.
All right, awesome. Yeah, so let's talk about a little bit what is a FICO score. I think a lot of folks hear, oh, my credit report, my FICO, and there's a lot of different terms, and they kind of mean the same thing. But I think something that a lot of folks will realize is the score that they see on their phones or their mobile banking apps is not necessarily the score that a lender is going to use when they pull somebody's credit report. Um, there are soft inquiries versus hard inquiries, and the score that you see on your mobile app is just a soft inquiry. They just base off information they have, and they look at some credit cards that you have outstanding, your utilization. But when they do that hard inquiry, that's when they go into deep details. They see the past dues on the account. They see your total credit history, the types of credit you have. Both of those inquiries do stay on your report and affect your score for 2 years. I'm
No,
sorry, a hard inquiry.
pause for one sec, Derek. Who would be a kind of person, like who would look at my credit? Why, what do I have to think about in terms of,
Yeah.
divorce and someone checking my credit score?
So let's say you have to get a new car after divorce. Your
Mm-hmm.
credit would be pulled for that auto loan if you're not paying for the car outright.
Mm-hmm.
Based on that your credit score at that point, you could have an intro rate of 0% for a few years if you have great credit, but they also might be like, oh, there's some history here of past due. Oh, it's kind of recent past due. I'm not sure what's going on there, so let's bump up their interest rate so we can protect our collateral, which is the car.
So you would end up paying more money out of pocket because you have
Yep.
a lower credit score. What about, let's say, we're getting divorced and the house, there's anything with the house, like say I stay in the house and my ex leaves, would anybody be checking my credit then? Or only if I'm looking for a new place myself?
Well, only if you're looking for a new place, but as if you were to go delinquent on your mortgage, that's going to be reported that next month, and you'll see a negative drop in your FICO score. So I think the easiest way to monitor your credit is to have one of those creditor monitoring services,
Mm-hmm.
um, like a LifeLock or an identity theft, where you can see, oh, there was an inquiry placed on my credit report. Who's trying to pull my credit? I didn't authorize that.
Mm-hmm.
And the sooner you can catch these things, the sooner that you have an ability to correct them. It's not a simple process to correct your credit report. There are a lot of hoops to jump through, but it can be done. And the best time to do that kind of correction is when you don't need a credit, or you don't need to have your credit pulled for any reason. You're not looking for a car, you're not looking for a house, you're not looking for a new credit card. that's the best time to kind of correct everything. Take a look at your report, do a little bit of an audit on it, make sure everything's correct.
Mhm.
To be in a spot where you apply for a credit card, you get the inquiry, you find out something that was inaccurately reported, and then you're declined for it.
Mhm.
Not only there, you have to reverse the inquiry, you have to correct what's on your credit report, and then you have to go back to the credit card company and say, can you reassess my application? It's a little bit of a process, so the best time to do that is when you don't have that added pressure that I need to do this right
And
now.
of course, like thinking of just myself, like I never do it because
Yeah.
if it's not urgent, like we just don't take care of it. That's
Mhm.
awesome
And
though.
another point that when there's urgency around a decision, you usually tend to make a quick, abrupt decision. And when you have more time to plan for things, and when things are calm, that's when you can make those clear, conscious decisions and weigh the pros and cons of everything.
Yeah, for sure. All right. I was gonna, one of the things that also came up was closing credit cards. Like the decades that I've been alive in the process, I've collected a number of credit cards and I thought, oh, just like clearing out clutter, shouldn't I just close credit cards that I don't use anymore?
So I see where you're coming from and why you would think that would be a good thing, but it's not when you consider a FICO score and the length of credit history that goes into it. Um, so length of credit history is about 15% of your FICO score. And let's say you just have one credit card and it's been open for 10 years. It's the only one you ever had. You paid on time. Everything's fine with that credit card. But then you open up a brand new card. So your score goes from 10 years down to 5 years based off just opening one card. And that length of history is cut in half right away. Um, so if you were to close a card, that's going to affect your score as well. So what I like to say is if you have a card, just keep it open, throw a pack of gum or something on it every now and then. You normally will get a notification when your account's going to be closed for inactivity, but that's also dependent on if you have paper mailings or if you have online notifications only. You need to be aware of, hey, I'm not going to get anything in the mail for this card, so it can be closed on me on any time. And the longer you have those cards open for, it just builds your length of credit history, which is a significant part of your credit score.
So what about like something being closed for inactivity? Does that harm your credit?
Yes, it's still going to show up as a
Uh-oh.
closed card. It will say closed due to inactivity on the credit report itself,
Mhm.
but it's when a lender looks at a credit report and they see a bunch of these kind of cards that are open and closed, and there's nothing really going on them. Maybe they put one purchase on there early on,
Mhm.
and then there's nothing else on there. That gives the lender a sense that, hey, maybe this person's kind of point shopping around. They grab the intro rate, they
Mhm.
get all the points and travel rewards that they need, and then they don't
Yeah.
use the that's somebody that's aggressively seeking credit for the wrong reasons, and that's something that a full underwriter would be able to see.
So as you're talking, I love to travel, and I know every time I go on a new airline, they're like, "Oh, if you get our credit card, it's free for the first year, and then you have to pay like some kind of fee." And of course, I imagine a lot of people think, "Oh, let's get the credit card for this airline because there's some perks and things." And then after the first year, you close it because you're like, "I don't want to pay the fee." So that's not good either.
Well, the annual fee does give you some benefits. Usually, a credit card has high rewards. They're going to charge an annual fee for it. Um, but it's the same type of instance. There's different like types of credit cards. Some have annual fees, some don't. Some are travel perks, some are cash
Mhm.
perks. But the more rewards a card has, that's where you're going to see those annual fees. But if that card was to close, regardless of the type of what type it is, it's still going to affect your score negatively.
Wow. Wow. Okay, let's talk about something you used the term and I can't remember it, but I was thinking about one of our clients who was saying she was having issues because um, with the credit cards, she had to put her legal fees on her credit cards. So she was getting to almost the max. She hadn't maxed them out and it was harming her credit. Why why? Like if she didn't go over, why would that not be helpful? And what's that word that you use where you spend a lot of like almost the amount that you're allowed to, but not quite?
Maxing out your credit cards,
Yeah.
and I think talking about is utilization of the credit
Yeah,
card,
yeah,
which is about
utilization.
30% of your credit score itself. So if you say, let's say you have $10,000 of available credit. So on between all your credit cards, all your credit lines added up to $10,000. And then let's say that one of those cards is like a $9,000 card and you're maxed out on that. So even though you have a bunch of cards, you only have $1,000 of available credit that you can still spend. That's going
Mhm.
to affect your utilization score. So when we talked about closing cards, that's going to lower the amount of available credit that you have because it's no longer available to you. So the higher the credit limit is across all your cards, let's say you have 100,000 between all your credit cards, but you only have $10,000 on a couple different cards and spread out.
Mhm.
That utilization rate is much different than $9,000 and you only have 10,000 available to you. You're kind of at your max
Mhm.
there.
Mhm.
So when a lender looks at those utilizations, they look at what is all available to them. Are the balances spread out between all these cards? Are they using one card a lot more than the other one? And then the more credit that you have, the higher of available credit that's available to you, so that utilization rate's lower. But yeah, amounts owed or utilization's one of the higher factors that goes into a credit score.
What about, a lot of people, when they've been in a long-term relationship and raising children, they don't work for a really long time. Like, how do you even begin to establish credit, especially if your partner's been the one who has the credit cards in his or her name?
Yeah, so there's a couple options for you. So those store cards are great starter cards. You just got to stay on top of them.
Mhm.
There's also cards where you can have a co-signer. So if you have a parent or a sibling that's willing to be your co-signer on your card, that's a great way to establish credit. But that is a little bit of a tricky dynamic because you're asking somebody to guarantee that this card is going to be paid off in full on time, and or not necessarily in full, but the minimum payments being made every month. And that doesn't happen, then both parties are responsible and both parties' credit would be affected. Um, One of the good options to build credit is a secured credit card. With that, you put up a collateral, like let's say $1,000, and your credit line would be $1,000. So for like 6 months to a year, you're using that card, you're paying it down, you're not going late. After a year or so of established history, they may graduate that card to an unsecured card where you would get your collateral back of $1,000, and then you would have that $1,000 card that you can use at any point.
What if
That
what if you don't have $1,000? Like, what if you have nothing?
if it, So there are different limits at different banks. I've seen as low as $500 to have a secured credit card, but that is a way to establish credit. And unfortunately, it is a thing that you have to establish. It can't be formed overnight. You have to build that history month over month of not going late, making at least your minimum payments, because anything under your minimum payment is going to show up as a past due. So biggest key there is making sure you make your minimum payments on your obligations that you have already.
All
Um,
right. As you're saying this, I'm thinking, but my kids, like when they're in college, they start getting all these applications for credit cards, and they don't have to put up $1,000 or $500. They're just given a credit card.
Sounds like
How
a
come someone who comes out of a relationship isn't given all these free credit cards
yeah.
as an adult?
So a lot of those cards are considered like a store card where as
Mhm.
long as you got a pulse, they're going to approve you. Your rate is going to be
Mhm.
horrendous on those cards because they expect people not to pay these off in full on time.
Oh, really?
Um,
Wow.
yeah, credit card companies make their money on the interest, not you running their card up left and right. It's the interest that they charge on that revolving balance.
Hmm.
Mm.
Wow. So speaking of that, what's the benefits of credit cards versus debit cards?
Yes.
Because I
So
thought it
uh,
was the same, and that was something the other day I thought, wow, Derek's got to talk about that.
yes. So there are definitely some benefits to using credit cards. We talked about the points that you get, but the biggest thing is the liability protection that you get. If you use a debit card, or let's say somebody uses your debit card and it's not authorized, jumping through those hoops to get that money back is a little bit tougher. And there are limitations on how much you can get back. A credit card, they're going to do their well, first they'll give you a credit back for the fraudulent charge, and then they're going to do the research and try to figure out how they can get their money back from that merchant who accepted a credit card without maybe checking their person's ID,
Hmm.
or they tapped it when they were supposed to insert it. There's different ways that credit card companies can check out that fraudulent activity. But as a consumer, the swiper, if you're the guarantor, you're protected on a credit card. The debit card, you're not going to be protected on.
Okay, so as you're saying this, we know someone whose ex committed some identity theft and ran up. Well, they applied for a number of credit cards in our client's name and got a few of them and ran up a huge amount of money. And of course, it really affected our client's credit score. So what do you suggest from like, your background on what our client might do moving forwards?
So if they have identity theft, they can place an extended fraud alert on their credit file where if anybody were to apply with their social for credit, the lender itself or the bank would have to call that person, one, get them on the line, and then that person also has to answer a bunch of questions that only that person will know,
Mm.
and only at that point will the credit report be unlocked, and the person could get credit cards or loans like that. That's something that has to happen if there is actual identity theft. But there are things that you can do to protect yourself against anybody pulling your credit report, even without identity theft. Um, so when I talk about this, I'm talking about credit
Okay.
freezes. It's a free TransUnion to Experian to Equifax, the three major credit bureaus that would get pulled. So the way it would work is somebody applies for credit. Let's say somebody applies for a credit card, the bank goes to pull their credit report. It says this credit report is frozen. A letter is then sent out to the client saying, hey, you have to unfreeze your credit report before we can do anything.
Hmm.
Uh, the customer would then call either Equifax, TransUnion, or Experian to remove that credit freeze. You can remove it for 24 hours. You can remove it for a week, for a month, however long that you think that you're going to need that credit report open so you don't have to keep falling back and forth.
Hmm.
But then after that time expires, it immediately is frozen again and nobody can access your credit report.
Okay. I'm thinking these days, I feel like every few months I get a letter from some company that says, oops, our data was breached and all your credit cards, like check your information. But I think that I had my stuff put on a credit freeze years ago. Does it just stay on this credit freeze?
Yes, it will stay on a credit freeze for
Okay.
you. Yeah.
And should
You would
anybody
have to.
not do this where they just have their credit frozen all the time because of all of these breaches?
I personally have my credit frozen at all times right now.
Mhm.
I know that hey, if I'm going to go buy a car, I'll go ahead and unfreeze my credit report for maybe a week, knowing that I might go to a couple different dealerships, and just know every time you go to a different dealership and they pull your credit, that's a fresh inquiry each time. So you just got to be a little careful with that, of how many places you're shopping around for and then getting your credit pulled.
Okay,
Um,
you have a question just came in. Is there a fee for the frozen fee?
no,
Like,
No,
okay.
there's no, it's completely free to add a credit freeze to your credit report. What you'll want to do is Google Equifax, TransUnion, and Experian freeze lines, and they'll give you a telephone number that you can call and add that freeze directly to your credit report. But you would need to do it for all three credit bureaus. Again, that's TransUnion, Equifax, and Experian.
Okay, great. Thank you. All right. So where were we? Um, Dissecting a credit report.
Yes. Yeah. So earlier in our call, I talked about where you can go to get a credit report or your actual credit report that a lender would see, and that is annualcreditreport.com. Again, that's annualcreditreport.com. That's the only trusted source where you can get a free copy of your TransUnion, Equifax, and Experian credit files right away. Um, what you want to look for on there is you kind of just want to do an audit. Do you recognize all the credit cards and all the auto loans and home loans that are on there? Is there anything that's reporting delinquent that shouldn't be? Or is there anything that you're showing a history, maybe it's like a 3 months ago. Oh, I'm reporting late on my Chase credit card. Why is
Mhm.
that? And then you call Chase and they said, oh, it was a mistake. Let's go ahead and correct that. They submit a request to, let's say, TransUnion to remove that past due, and then you're all good. Um, but I specifically talked about looking for individual or guarantor cards versus authorized users.
Mhm.
Authorized users are going to show as an AC for authorized contact, or AU. It will be right next to the card name itself.
Okay.
Um, that means that you are not responsible for that card. Somebody else guaranteed it or is the guarantor. If you see a P for primary, I for individual, or G for guarantor, that means that that is in your name and it's reporting to your score. So if you were to go late on that card, that would affect your score. So again, you're looking for inaccuracies on past due information. You're looking for to make sure everything that you see there is something that you have, is an accurate credit card, for instance. And then you're looking for either authorized user, primary, guarantor, or individual user. That's going to let you know who is the guarantor of that card, or who is going to be responsible for anything negative or positive for that matter.
All right. So one of the things we see all the time are people in our communities whose exes have opened up credit cards in their names, and they're just running up bills. I mean, kind of like the example I mentioned. So let's say you suddenly see that there's all these credit cards and you're the primary or the guarantor and you never signed up for that. Like, what do you do?
First, you would want to call the credit card company and report that it was opened up as fraud.
Okay.
They would be the ones to give you some information about how to go to report that as identity theft. I wouldn't want to get into that information because each bank's a little bit
Yeah.
different on.
Okay. Good. All right. So you had talked about some other, I don't know if there's other resources that you wanted to mention that people can use.
Yes. So we talked about annualcreditreport.com. I would definitely recommend doing that at least once a year to kind of get an audit on your credit files. We talked about credit freezes, and the best way to go about that is Googling TransUnion, Equifax, and Experian freeze numbers. And it'll give you an 800 number that you can call. You can also go to our website at our firm, blackdiamondfs.com/divorce. We have a little workbook and some checklists for you if you're kind of just getting started on this process. And through there, you can always reach out to us and to me directly if you had any specific questions that you didn't want to answer on Instagram Live today.
Great. So how can people find you directly, Derrick?
Yeah, sure. I'm on LinkedIn, Derrick Diksa, Diksa. I'm also, you can find me through blackdiamondfs.com. My information will be on there. But yeah, should I give my email
Yeah,
or? Yeah,
go
sure.
ahead.
It's Derrick, ERRICK at bdfsmail.com.
All right, excellent. Well, thank you so much because it was definitely enlightening for me. And of course, I feel guilty because I haven't ever done an audit, and I really should. So I think I should mark it on my calendar as like a date to do it.
Yeah, set a recurring reminder. It's just one of those unnecessary, or not unnecessary, one of those necessary things that you got to do. It's not fun. But the best time to do it, like we said, is when you don't have something on the docket or that you need to get it done right away.
Yeah, yeah. It's almost like a physical, an annual physical. You got to
Yeah,
just do it.
and these tips are good for people going through divorce, or after divorce, but it's also good for anybody that is in this instance where um, they want to just protect themselves. And I think the best thing you can do is just place a quick credit freeze on your credit file. That's going to protect you from anybody, including a spouse, opening up anything in your name.
Yeah. Wow. All right. Well, thank you so much, Derrick, for coming on today.
It's been a pleasure, Lisa. Thank you for having me.
All right. We'll talk soon.
All right, have a good one.
You too.